You've heard the name 1,000 times on the news, from a friend who suddenly invests now, in some headline about the market being up or down or having its worst day since something. The S&P 500. 3 letters and a number that somehow decide whether millions of people had a good day or a bad one. But here's the strange part. Almost nobody who repeats it can actually tell you what it is. They treat it like the weather, something that just happens to them. So let's fix that. Because once you understand what this thing really is, you'll never look at your money the same way again. Start with the simplest version. The S&P 500 is a list. That's it. A list of 500 of the largest companies in the United States, all bundled together into one number. Apple is on it. So is Coca-Cola. So is the bank that holds your paycheck and the company that makes the chip inside your phone. When people say the market went up today, this is usually the market they mean. But a list of 500 companies isn't very useful on its own. How do you turn 500 different stock prices into a single number that goes up and down? That's where it gets interesting. Imagine you tried to average them the naive way. Add up all 500 stock prices, divide by 500, done. The problem is that a company's stock price tells you almost nothing about how big the company actually is. A tiny company can have a price of $400 a share. A giant can trade at $30. Price alone lies to you. So the S&P 500 doesn't care about price. It cares about size. Specifically, the total value of each company, which is just the share price multiplied by how many shares exist. That's called market capitalization. Market cap. The bigger the company, the more it counts. This one design choice changes everything. It means the S&P 500 isn't a democracy where every company gets an equal vote. It's weighted. A handful of the biggest companies at the top can move the whole number, while hundreds of smaller ones barely register. When you hear the market is up, what you're often really hearing is a few enormous companies had a good day. Now, where did this thing come from? Because it feels ancient, like it's always been there. It hasn't. The 500 company version launched on March 4, 1957. But the story behind it goes back much further, to a man named Henry Varnum Poor. Back in 1860, before the light bulb, before the car, Poor started publishing detailed financial information about American railroad companies. Railroads were the hottest investment of the age, and investors were pouring money into them blind, with no real data. Poor gave them the numbers. He gave them a way to see. That instinct, the instinct to measure the market instead of just guessing at it, is where the Poors in the name comes from. Decades later, his company merged with another called Standard Statistics. Standard and Poor's, Standard and Poor's. And in 1957, with the help of early computers, they built something that had never existed at that scale. A single index tracking 500 major companies updated constantly. For the first time, you could glance at one number and get a read on the entire American economy. That was revolutionary. But here's a question. Who actually decides which 500 companies get in? You might assume it's automatic, the 500 biggest ranked by a machine. It's not. There's a committee. Real people at a company called S&P Dow Jones Indices sit in a room and decide. A company has to be profitable. It has to be big enough. It has to be American. And it has to meet a list of standards. Then the committee votes it in or out. Which means the S&P 500 is quietly a survival story. Companies fall off the list when they shrink, get bought, or fail. New ones climb on as they grow. The index you see today is not the index from 20 years ago. It's constantly shedding the losers and absorbing the winners, almost like it's alive. It doesn't get emotionally attached to a dying company. It just replaces it. And that brings us to the part that actually affects your money. For most of the 20th century, ordinary people couldn't really own the whole market. If you wanted to invest, you paid a professional to pick stocks for you, and you paid them well, whether they were right or wrong. The pitch was simple. Trust the expert. They'll beat the market. Then a man named John Bogle asked a dangerous question. What if they can't? Bogle had studied the data, and it pointed to something uncomfortable. Most professional stock pickers, after you subtracted their fees, did not beat the market. They didn't even match it. All that expertise, all those confident predictions, and the average investor would have done better just quietly owning everything. So in 1976, Bogle launched something radical through his company Vanguard, a fund that didn't try to pick winners at all. It simply bought all 500 companies in the S&P 500 and held them. No genius, no forecasting, no expensive manager guessing what happens next. Just the whole list at the lowest cost possible. People mocked it. They called it un-American. Why settle for average? Bogle's answer was that in investing, average quietly beats almost everyone who's trying to be exceptional. He was right. And over the following decades, this boring idea, the index fund, grew into one of the most powerful forces in finance. Today, when your retirement account or your first investing app puts your money in the S&P 500, you are living inside John Bogle's argument. You are betting on all 500 companies at once, instead of trying to guess the one that wins. If you still doubt whether this simple approach really holds up against the experts, there's a story that settles it. In 2007, Warren Buffett, one of the greatest investors alive, made a public bet, $1 million. He wagered that a plain, cheap S&P 500 index fund would beat a hand-picked basket of elite hedge funds over 10 years. The professionals took the bet. These were people paid enormous fees precisely because they were supposed to outsmart the market. 10 years later, Buffett won. It wasn't even close. The simple index fund, the one that did nothing but hold the whole list, crushed the experts who spent every day trying to be clever. So let's go back to that number on the news. The one people repeat without understanding. The S&P 500 isn't magic, and it isn't the weather. It's a living list of America's biggest companies, weighted by size, curated by a committee, born from one man's obsession with measuring the market instead of guessing at it. And its greatest lesson has nothing to do with being smart. It's the opposite. The market rewards the patient far more reliably than it rewards the clever. Owning everything cheaply and waiting has quietly beaten most of the people who were sure they knew better. You've heard the name 1,000 times. Now you know it was never describing the market from the outside. If your money is invested at all, that number is describing you.